Choosing your Forex broker is a decision that should never be taken lightly. To help you out, I'll explain the 3 types of Forex brokers out there and the pros and cons of each of them.
First up, we have the market makers, or dealing desks. Each market maker will obtain his price feed from the interbank market. This refers to the immense liquidity pool generated through the transactions between the world's largest banks. Retail traders can only access this liquidity pool via their brokers. When you send out a buy order from your trading platform, the broker will find the cheapest quote from his price feed and mark it up with a spread. He then sells it to you, filling your order. You now have a position in the market. Crucially, the market maker serves as the counterparty to your trade. Your trades are held with the broker and never pass to the interbank market. They can choose to hedge your order, meaning they transact in another market to balance risk, which is perfectly legitimate. The alternative is to take the opposite side of the trade, meaning they trade against you. Sounds like standard practice so far, but things can get interesting during volatile markets. Suppose the broker can't find a quote that he can pass to you at a profit. Chances are your original order will get rejected, and your broker will offer you a worse price, which you can either accept or reject. This is called a requote, and makes it difficult to enter or exit your trades quickly. The more pressing issue is the conflict of interest arising when your broker trades against you. Whenever you have a losing trade, the broker profits, and vice versa. Since most traders lose money, this is a fairly reliable way for your broker to make money. But what if you become too profitable for your broker's liking? This is where sneaky tactics like price manipulation and stop hunting come into play. Volatile markets are great opportunities for these shenanigans. It's not uncommon for spreads and slippage to widen drastically or have your trading platform suddenly freeze, making it practically impossible to open or close trades. And remember the stop loss and profit targets you entered when placing your order? The market maker knows where they are. Don't be surprised if prices mysteriously gravitate towards your stop loss or away from your target. Of course, these tactics aren't employed too frequently, or it would be too obvious. But because they're so difficult to prove, they're still employed by the less reputable brokers. Market makers therefore make money through the bid-ask spread, and by trading against losing clients. With that, let's summarize the pros and cons of market makers. For pros, they don't charge commissions. Maybe some also provide advanced charting capabilities or good news feeds. Cons include requotes and possible price manipulation around key levels. If you use a fast scalping strategy, the requotes and manipulation will almost definitely destroy your expectancy. Some market makers openly discourage scalping, or will just straight up close your account without any reason given. The second type is the ECN broker, which stands for Electronic Communications Network. These brokers provide access to the interbank market, where participants of all sizes can trade against one another by placing bids and offers into the liquidity pool. When you place a buy order, the broker routes it to the interbank market, to be matched with a seller at your desired price. Once found, the order confirmation is sent back to you via the ECN broker. All this takes place anonymously, with your type of strategy and its key price levels unknown to the counterparty. ECN brokers do not profit off the bid-ask spread, so spreads will be variable, sometimes as low as 0. Instead, they profit by charging a commission per round turn. This usually ranges from $3 to $7 per lot, per round turn. This is independent of your trade outcome, hence there is little incentive for the broker to interfere with your trades. In fact, the more you win, the more you trade, and the more commissions the broker receives. It's a win-win. For the pros, you get access to the best bid and ask quotes, direct from the interbank market. This means the tightest spreads, most volatile prices, and you won't get requotes. ECNs have the fastest execution times, which is great for scalping. Most importantly, there is no conflict of interest because the broker does not trade against you. The only real con is the inclusion of a commission per trade, but if you offset this with the lower spreads you're likely to get, it doesn't make much of a difference. The straight-through processing broker is like a hybrid of the market maker and ECN broker. Like the market makers, STP Brokers first obtain their quotes from the interbank market, with a little spread added. STP Brokers don't have a dealing desk, and their name implies that your orders are routed directly to the interbank market, without any broker interference, but that isn't always the case. How your orders are routed depends on whether you're an A-book or a B-book client. A-book clients are profitable traders who generally trade larger volumes, while B-book clients are small volume, losing traders. If you're an A-book client, the broker knows you have a good trading record, and doesn't want to trade against you. Your order will be routed to another counterparty that could be the interbank market or another broker, much like what ECN brokers do. This keeps risks low for the broker, while earning from the guaranteed spread. But if you're in the B-book, the STP broker wants to profit from your loss. He will have the option of keeping your order in-house, either hedging it, or trading against you, much like what the market makers do. STP brokers therefore profit from spreads, and by trading against losing clients. You may get direct access to the interbank market, but you'll never know for sure which book you're in. Pros are similar to what you will get with an ECN broker, meaning competitive quotes, low spreads and fast execution, but only if you're an A-book client. STP brokers also usually don't charge commissions. For cons, if you're in the B-book, conflict of interest, and the associated broker tactics, once again rear their ugly head. Even if you're in the A-book, execution times will likely be slower than those for ECN brokers, depending on which liquidity provider eventually fills your order. So that's a roundup of the three main types of Forex brokers, which mainly differ in terms of how your orders are routed through the market. What's my recommendation? Get an ECN broker, since they probably want you to succeed. Of course, anyone can market himself as an ECN broker. Sometimes you really need to open a small live account and examine your trading conditions. Pay attention to execution speed, spreads and price movement in relation to other brokers. Like your trading strategy, broker selection should be a form of ongoing research. Have an open mind and don't be sold on the latest rebate or the illusion of commission-free trading. For added protection, keep your accounts within the compensation limits offered by your local regulator. This means, should your broker go bust, you will get at least a portion of your capital back. This could mean spreading your risk across multiple brokers, or limiting your trade size. Hope this helps with your broker selection. If you want to learn how to program your own trading strategy without coding, check out the video at the top right. To find out which markets trend best, check out the video at the bottom.